What are we missing? What's the hole in the argument? What's the rebuttal to the SoFi bear case?
Well, there's a few things that I would talk about. You were talking about the quality of the loans, but I make six figures. I have a 780 credit score. They were still denying me loans.
That's a very good point. It's important to then look at the performance of the loans. It's not necessarily linear when you look and compare the numbers versus other lenders because they're cycling and selling. They're also growing faster for a while, and there's a huge denominator effect. What's interesting, though, if you were to compare them to, let's say, a lending club, the loans are obviously different. SoFi's average personal loan is in the $30,000 range, whereas lending clubs by mid to high teens. But if you've actually seen, you've seen an inverse pattern where SoFi's FICO scores have gone from the 760s and down into the 750s and then potentially a little below. Whereas you've seen the opposite of Lending Club where they've gone upstream. And they're effectively in a similar bucket, slightly different income ranges, but also different loan values. So the ultimate question here is we're debating prime versus super prime and two companies that are on the edge. So yes, the loans are good quality. They've also pulled back. The question is, why did they pull back? And you're obviously seeing that there's been some credit underperformance of previous vintages. It's obviously made some mistakes in the past. Is it fatal? No. But in a sense, are they really that different? They've made mistakes like a lot of others. They've done some things better. They've done some things worse. But in a sense, does it make it something that is that much incredibly better? I have a hard time saying that it's really a true differentiator.
They were slowing the lending or just keeping it flat right now. And they were transitioning into making their growth come from their financial services and their tech platform, right? And as you know, they've guided for 80 cents per share. If they make 80 cents per share, you think that it was aggressive and they pulled growth from forward.
So in a sense, I struggle to get anywhere near that in the model without making very aggressive assumptions on growth or where they're marking loans day one.
So they've repeated it over and over again. So what do you think that we're missing?
I think that the other thing to consider is also, it's nice to have projections and forecasts, but I think what's also relevant is that, and hopefully not misquoting the exact numbers, but it seems like what they've been referring to is 20, maybe up to 25% growth for the technology platform. I'm already there or above that in my model. And you referenced the financial services segment. One thing that I think, and that's a very interesting topic and question, but when you look at this company and you take a little bit of a step back, the financial services segment last quarter is growing revenues materially, but the vast majority of those revenues are not because of the financial services segment, in my opinion, at least. What they're doing is the way that they're effectively categorizing is that the financial services segment owns the deposits and the funding and then lends them to the lending segment. So when you look at the net interest income is skyrocketed at the financial services segment, and that's driving the vast majority of all the revenue growth and profitability growth. But if you were to kind of unpack that, they do report the interest recognized for the loans in the lending segment. So we can get a rough proxy of what the amount of interest the lending segment is actually paying to the financial services segment. And based on my model, in the first quarter of 23, they paid 145.7 million in interest, and that increased to 333 million. So if you were, gross revenue versus net revenue, because they're reporting on a net basis, but the vast majority of the growth in the financial services segment is being driven by the lending segment. So in many ways, it's a different segment, but it's really just shifting revenue that is really lending over from one side to the other. At the end of the day, your deposits and your loans are all part of the bank.
Well, the contribution profit of the lending side is still high and growing itself too. So even if that's true, it's accelerating as fast as it's going, and they're guiding for it to continue in the future. What's the problem?
At the end of the day, it should all be my argument is that it should all be put together because you're really separating two parts of the same thing by separating the segments. So in a sense, part of the reason why the growth should be stronger there versus the lending segment is because you're shifting more from lending to financial services. So in some ways, it's really the same thing. But what that also comes back to is that when you think about the growth needed to get to where they want to get to in 26, the majority of that growth is from them becoming even more of a bank and becoming even more of a personal loan and student loan focused entity.
I actually never thought about that.
So in a sense, like, because it's all the same, what we're really saying is most of the growth, the tech platform is interesting. It's generating a lot of value. It's growing. That's great. And that's all great for SoFi. And that's a positive for the stock. But most of the growth is still coming from lending and becoming more of a bank and more of a consumer bank and more of an unsecured personal lender and a student lender, among other things. And they obviously are discussing growing.
They're guiding for the tech and financial services to become a larger piece of the pie.
My argument is the financial services segment is really is the bank. It really is the lending business. So if you look at what's in financial services, there's 30.8 million of non-interest income in the first quarter of 24. Almost all the interest income is bank. It's making loans. It's senior secured loans. It's lending to loans. Of that 30.8 million, you have roughly 25 or so million, I'm rounding a little bit, that is interchange, which is related to being a bank. It's the interchange on credit cards, debit cards. You then also have referral fees on the turn downs from the lending segment, so the loan that they turned down. In a sense, when the two of us both applied for a loan on SoFi as an example to test it out, we probably were then sent to Upstart, Lending Club, and others, and those companies pay a fee for that, which is really still associated with lending, which is a big chunk. And there's 4 to 5 million of wealth management fees, or brokerage related fees, which are part of a bank. Almost all large banks have some sort of brokerage or wealth management. So my point is, whether it's financial, in a sense, the company likes to look at financial services and tech together as the growth engine. But at the end of the day, in my opinion, financial services and lending should be put together and tech should be separate.
So when rates come down the next year after that, eventually they're going to get to where they can just cycle almost the whole loan book every quarter, like how they were doing. And with the amount of deposits they're getting, I think that it will accelerate maybe more than
you're making an interesting point. I think that there's an inherent challenge in that. And it's that it would only truly, in my opinion, it would only truly be accretive to sell additional origination volume that you can't keep. Because in a sense, even if you took the current portfolio, for the current personal loan portfolio, and you sold 100% of originations this year, let's say it's all at 107, let's go way above where they're claiming they're selling from an execution perspective, and then just look at the expense base, your earnings would actually fall materially because a lot of the value of the loans is actually the interest on the back end. So selling more and recycling it faster is not necessarily accretive. Having the balance sheet and leaving loans on balance sheet is actually more valuable on a relative basis.
If they're able to hold a certain amount and then sell the rest of their capacity.
And the excess capacity. At this point in time, they have, from a capital ratio perspective, they have a lot of capital. They have a 17.1% CET1 ratio. The way I would look at it through a couple of different lenses, and I think where the discussion often goes with institutional investors is that if you think about the messaging and then also capital, later in 23, they pivoted from saying we're going to grow through 24 to saying we're probably not going to grow in 24. Then they did a CDS deal on $2.5 billion notional to get $2 billion of RWA relief. That's a capital relief transaction. Then they equitized a large portion of the convert, which is great execution. It's a great way of raising capital. But in some ways, they've done a lot of things where slow growth, do a capital relief transaction, raise more equity and capital through a very interesting creative transaction that was much better than trying to raise equity in the public markets in the sense of doing a traditional secondary, in my opinion, at least. But then the question becomes, by the end of 25, I'm back down to a 15.1% CET1 and then 14.1%. In my model, if you were to look at them on more of an apples to apples basis, the end of 24, 25, and 26 versus a lending club where if I assume that they had no fair value premiums, and on top of that, they didn't have provision, at the end of 24, I'd be at 9.1, I'd be at 7.2 in the end of 25, and I'd be at 5.8 at the end of 26. So in many ways, in my opinion, the only reason why SoFi is where it is today is because of fair value. And the only way that they're going to be able to get to where they're going is by not hitting any speed bumps and continuing to run along this course and arguably improve the way that they're marketing loans as opposed to deteriorate. So that is something that becomes difficult. And then what I would then overlay on top of that is, in my model, my accumulated fair value premium, or the current total accumulated fair value premium that they've already recognized as of the first quarter, is $856.5 million. In my model, that increases to $1.122 billion at the end of 24, $1.5 billion, and just over $1.8 billion. In many ways, more than 100% of the earnings that I'm forecasting are coming from pulling forward earnings with fair value premiums. And in some ways, that also deteriorates the value of that earnings stream.
And look, there are these leading bank core providers. They're incredible oligopoly businesses. They're dinosaur companies, and they're entrenched in the banking sector. And you can see that stock price is going up. They make money selling tech to banks, these bank cores that SoFi is trying to enter the market in and trying to pull share away. So the point here is that product market fit's hard. If you want to enter and compete against a bank core, many startups have tried and failed. Just haven't done it. It's highly regulated category. Banks are conservative. Changing out your bank core is the last priority a bank ever has. Right now, they're addressing commercial real estate issues. They want to stop deposit flight. They want to make sure they can refinance their existing customers. And those are their priorities.
There's also a lot of inertia when it comes to bank cores. An analogy, I don't currently cover the company, but at a previous firm, I worked on a team that covered Q2, for example. They're a very interesting company. They were bringing a new product to smaller banks, SaaS-based, complete bank core structure to a lot of community banks, smaller banks that had disparate systems. They had a mobile system, an online system that didn't even communicate. They grew very well. I think that the underlying question, to your point, there's an oligopoly or duopoly at the top for larger bank cores. Banks are typically risk averse. And it takes a lot of time for a bank to jump out and say, I'm going to jump to this newer core that only a few people are willing to adopt today. So it's going to take time. They're obviously making progress and they're growing. They're making an impact. And that's obviously good, but it can take some time. I mean, when you're looking through the RFP process, almost all the end customers should be looking at multiple providers and trying to get RFPs from everyone, because we're talking about getting RFPs from 5, most maybe 10, 10 on the outside type of providers. So it can take a lot of time before you work your way into that sector. I mean, obviously it's a lucrative business if you can make your way in and grow, but it's important to then look at that business appropriately. It is still part of a bank, and it's hard to give, at the end of the day, a sum of the parts valuation